Good afternoon, everyone. Hope you're having a great day. I'm Kimberly Castillo and we're discussing all about financial modeling best practices. Now let's start with what is financial model. A financial model is simply a tool that's built in spreadsheet software such as MS Excel to forecast a business financial performance into the future. The forecast is typically based on the company's historical performance, assumptions about the future, and requires preparing an income statement, balance sheet, cash flow statement, and supporting schedules known as a three-statement model. From there, more advanced types of models can be built such as discounted cash flow analysis, DCF model, leverage buyout or LBO, mergers and acquisitions or M&A, and sensitivity analysis. Now there is an example of financial modeling in Excel. The output of financial model is used for decision making and performing financial analysis, whether inside or outside of the company. Inside the company, executives will use financial models to make decisions about raising a capital, making acquisitions, growing the business organically, selling or divesting assets and business units, budgeting and forecasting, capital allocation, valuing a business, financial statement analysis or ratio analysis, and management accounting. The best way to learn financial modeling is to practice. It takes years of experience to become an expert of building a financial model, and you really have to learn by doing. Reading equity research reports can be a helpful way to practice as it gives you something to compare your results to. One of the best ways to practice is to take a mature company's historical financials, build a flatline model into the future, and calculate the net present value per share. This should compare closely to the current share price or the target prices of equity research reports. It's also important to establish a solid base understanding by taking professional financial modeling training courses such as are offered at CFI, with many locations across North America or directly online. Financial modeling is an iterative process that you have to chip away at different sections until you're finally able to tie it all together. We're going to discuss further the step-by-step breakdown of where you should start and how to eventually connect all the dots in doing financial modeling. First, every financial model starts with a company's historical results. You begin building the financial model by pulling 3 years of financial statements and inputting them into Excel. Next, you reverse engineer the assumptions for the historical period by calculating things like revenue growth rate, gross margins, variable costs, fixed costs, AP days, inventory days, and AP days, to name a few. From there, you can fill in the assumptions for the forecast period as hard codes. Now, we can start now to the income statement. With the forecast assumptions in place, you can calculate the top of the income statement with revenue, cost of goods sold, gross profit, and operating expenses down to EBITDA. You will have to wait to calculate depreciation, amortization, interest, and taxes. Start the balance sheet with the top of income statement in place. You can start to fill in the balance sheet. Begin by calculating accounts receivable and inventory, which are both functions of revenue and cost of goods sold, as well as the accounts receivable days and inventory days assumptions. Next, fill in accounts payable, which is a function of cost of goods sold and accounts payable days. Build the supporting schedules. Before completing the income statement and balance sheet, you have to create a schedule for capital assets like property, plant, and equipment, as well as for the debt and interest. The PP&E schedule will pull from the historical period and add capital expenditures and subtract depreciation. The debt schedule will also pull from the historical period and add increases in debt and subtract repayments. Interest will be based on the average debt balance. Next is complete the income statement and balance sheet. The information from the supporting schedules completes the income statement and balance sheet on the income statement, link depreciation to the PPE schedule and interest to the debt schedule. From there, you can calculate earnings before tax, taxes and net income. On the balance sheet, link the closing PPE and balance and closing debt balance from the schedules. Shareholders' equity can be completed by pulling forward last year's closing balance, adding net income and capital raised, and subtracting dividends or shares repurchased. Next is build the cash flow statement. With the income statement and balance sheet complete, you can build the cash flow statement with the reconciliation method. Start with net income, add back depreciation, and adjust for changes in non-cash working capital, which results in cash from operations. Cash used in investing is a function of capital expenditures in the PPE schedule, and cash from financing is a function of the assumptions that were laid out about raising debt and equity. An effective and efficient model is one that can help a company to see and reach their future performance goals in various situations. This means that in order for a financial model to function successfully, the quantitative values that are documented need to be realistic and appropriate. The model should reflect key business assumptions directly without being overbuilt or cluttered with unneeded details. This will ensure the model remains truthful and represents reality and that is reasonable, with previous data or performance numbers, defensible assumptions, and projected performance. The assumptions and conclusions must be very clearly conveyed within the model. It must be flexible, easy to follow and understand, and must be appropriate. In order to build a financial model, you need a solid understanding of accounting fundamentals. You have to know all the various accounts, mean, how to calculate them, and how they're connected. We recommend having at least a few accounting courses under your belt. Financial model is a representation in numbers of a company's operations in the past, present, and the forecasted future. Such models are intended to be used as decision-making tools. Company executives might use them to estimate the cost and project the profits of a proposed new project. Financial analysts use them to explain or anticipate the impact of events on a company's stock from internal factors such as change of strategy or business model to external factors such as a change in economic policy or regulations. Financial models are used to estimate the valuation of a business or to compare business to their peers in their industry. They also are used in strategic planning to test various scenarios, calculate the cost of new projects, decide on budgets, and allocate corporate resources. Example of financial models may include discounted cash flow analysis, sensitivity analysis, or in-depth appraisal. And that would be all, and now let's proceed to the next topic to be discussed by the next speaker.